Hello everybody and welcome to Confident Compounding with Corey Kramer. Today I'm going to be sharing my thoughts on EXL Service Holdings Inc. stock, ticker EXLS. This one came in down in the comments of one of my other videos. If you have a stock you'd like me to take a look at on the channel, just put it down in the comments. I just went through and got back to everybody that's asked about stocks the past week or so. So you should have a reply from me. My chalkboard's getting filled up again. And I'll either post the video here on YouTube or on the free tier over on Patreon. So check out the free tier over on Patreon. Down in the comment section, there's a link there. And I have weekly picks over on Patreon too. Each week, I try to find the best stock I can in the market. That service is not free. It's $25 a month. Just put out a new weekly pick today. And I have a video where I share some of the results and how those ideas are performing here. I usually put those out quarterly. So if you go look a few weeks back, you should be able to find that here on the channel. As always, this is not individual investing advice, just how I analyze stocks. Okay, so EXL Service, I actually hadn't heard of this business before. So that's one of the things that makes my job interesting is people ask me about things that I haven't looked at, and then I get to just look at something fresh instead of talking about NVIDIA all day long like everybody else that does what I do. So, and then it was even more interesting because I opened the fast graph. I do have an affiliate link in the bottom of all my videos for fast graphs too. I don't always mention it, but you can get 25% off if you want to check it out. I use it in pretty much all my videos. It's really good for initial kind of valuation work. And then I also have the international stock add-on, so I can look at international stocks, which is nice. If you use an earnings-based analysis or you just want to see what the historical cyclicality is really quickly, so you can sift through stocks really quickly and make decisions about them, about whether you want to do more research or not, it's excellent for that. So I was really impressed when I looked at the earnings growth here. So that's kind of the dark green shaded area here on the fast graph. Let me close this in so we're not projecting too much into the future. So over the past 20 years, like 15% earnings growth, which is fantastic. And it looks like it's accelerated recently. However, what does jump out at me, so that's all great. I mean, it's hard to find earnings growth over this period that's been this good for very many companies that aren't named like Google or something like that. So, but if we shorten it and we go back and look at the Great Recession, which was the last real recession we've had, it's just been so long since we've had one, we get a little bit of a different story here. So these guys are in data processing and outsourced services, which captures a lot of different things. They're about $7 billion, so not super huge, but not super tiny. When I look at this, I see earnings fell 60% in 1 year in 2008. And then they were, it took a couple years for them to recover back to their peak here, but it didn't take too long. Usually if earnings fall more than 50% during a recession or something, I consider that a deeply cyclical business. So even though the earnings haven't been cyclical since the Great Recession, that was also the last real recession we've had. And that means that, so if you look at kind of the peak-ish PE here, it's about 30 in October of 2007. And when earnings fell 60% over the next year, almost exactly a year it looks like, the stock fell 80%. All right. So we have deep earnings cyclicality, we have deep stock price cyclicality. And so what I want everybody to take away here is there's a couple things. I'm not going to do a normal valuation analysis on this one because it's potentially deeply cyclical. But if you don't go back far enough in time, you wouldn't necessarily notice that. So if we go to the current day and we kind of look at the peak PE, well, guess what? It's almost exactly the same as it was in 2007. So everything was going well back then. If you look at the earnings growth that year, they grew 56%. If you go back to 2007. And this past year, they didn't grow that fast, but a solid mid-teens to 20%. So we have a very similar peak PE. And what happened was, now they didn't think in 2007 that 2008 was going to fall off a cliff like it did, but it did. So if earnings in, say, 2026 were to fall 60%, you could expect this stock to fall 80%. It's only down 20% now. So it could still fall another like 70%, 75%, something like that, if that pattern repeats. Now, you have to probably have some kind of recession in the normal case scenario for that to happen. But most stocks that you're buying right now, even if they have a good growth rate of in the mid-teens here, which is fantastic, maybe not quite enough to it's close enough to justify the valuation. It definitely would have been back here, down in the teens. Right now it's at 23 PE with mid-teens growth. I mean, that's better than most stocks in the market right now. So you could see how that on a valuation metric, especially if the stock price falls a little bit more, it could definitely look attractive, but it's very dangerous if we do have a recession and if earnings do fall. You'd be paying way too much, and you'd have to sit through like a 65% drawdown probably. However, we've gone a long time without a real recession, so if we don't have one and they keep earning 15% a year, I mean, the stock price could grow 15 or 20% a year for the next few years until whenever the next kind of recession happens, if the patterns repeat themselves. Now we have to go back a long way to find the last recession, and things have changed a lot, which is kind of what I'm going to talk about next. But that would be my initial worry about using any kind of earnings-based valuation, is if earnings fall during a recession, the stock is probably going to get totally creamed. Now, one way I can double check that is to go back to 2020 and say, okay, how did the market treat this stock during that? It wasn't a real recession, but we get to see how the market was thinking, right? I think the market fell maybe like upper 20s to 30% or something. I could double check it. But it fell about 45%. So it's falling, we'll call it 50% deeper than the market fell, which is about the same rate it was falling in 2008. So there's some reason to think here that the market will probably treat this stock similarly as it did in the past if we have another recession again, because that's what it was banking on in 2020, even though earnings grew 14%, right? So that's a tip off that the market probably isn't going to cut this stock much slack. It looks like it behaved a little differently than the wider market in 2022, but we do get a 30% decline here in 2023, which is probably, again, more than the market fell. I think the market fell about 20 during that drawdown. So lots of price danger, and the market's going to do it. It's going to send the stock lower before the earnings show it. The market will, take names later. Like, it will sell the stock off first, ask questions later. So pretty dangerous to own it unless you really think we're at the beginning of a long upcycle. Let's say you thought that in 2020 and you went ahead and bought it, so you'd be up like 300%. So if you want to take a shot at something like this, you really want it, and I don't even consider that like a real business cycle, but we got a bunch of stimulus, so it sort of acted like it. You can't, historically it's been investable if you pay a low price, and you can get extremely good returns. So the risk reward starts to look a lot better when that stock price is getting really hammered, if you can come and buy a little bit of it. Okay, so the other thing I wanted to talk about, so that's kind of lesson number 1. Lesson number 2, I mean, it's not really a lesson, just kind of my thoughts. I'll show you a little trick, basically, is what I use. So what I've noticed is for all these, what are they, data and outsource service companies. So this is ChatGPT. So it's going to go on the web. It's going to look up, I didn't look up the exact sources. Oh, they have some of the sources in here, right? It's pulling this directly from their company website, which is pretty obvious when you start to look through it. So all of these, all the companies, pretty much all the companies in this industry, there's a threat that AI could take a lot of their business, or that could do the business more efficiently, right? Outsourcing services. So whenever you read anything about them, especially when it's all coming from the company website, you're going to get the version that the company is trying to put out there into the world. So when I read through this, I don't know how many times they mentioned that they're an AI and automation company, but it's a lot, right? So the number one thing, data analytics and AI powered operations. Okay, all right. I don't know anything about this company really, other than I saw what industry they were in. Um, they offer services including enterprise data strategy, platform modernization, generative AI, hyper automation, digital strategy, AI. It's just AI, 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 AI. Because the market is looking at a lot of these companies and thinking, okay, maybe AI is going to be able to do this job better than outsourced to some other place. So my shortcut on kind of cutting through all this without doing like a bunch of research when it comes to businesses like this is it's a $7 billion market cap company, okay? The first thing and the main thing I check is not what they tell you they're doing. It's how many people they employ. And that's in here. So it's only a $7 billion company, and they have 54,000 employees across 60 locations in the Americas and then all over beyond, right? So that's a lot of employees. And that tells me that if they were really using AI to do all this stuff, they probably wouldn't have 50,000 employees. They wouldn't need that many. I mean, I don't even know if Meta has 50,000 employees. So that doesn't mean that they can't. And I think they did. There was a note in here somewhere. Let me find it. Let's see. Originally a business process outsourcing firm, they have pivoted toward data analytics, AI, and digital transformation. Okay, that one comes from Wikipedia. So they're giving you what they actually used to do, and what they're trying to pivot to or have pivoted to. So I don't want to take anything away from these guys. If you kind of see what the future is going to be and you want to get in front of it, but so that's all great, but I like to see it kind of proved out, before. I don't really bet on a company changing too much from what it's done historically unless I really understood what it was they were doing and I could really envision it. And I don't know enough about this industry to be able to do that. So I just go back to being cautious. I assume that history is going to be similar. I understand they're trying to change, and that's their goal, and I wish them the best of luck. But it's not something that I'm usually going to bet on unless I really feel comfortable, like I understand it, which I do not. Absolutely, I do not understand the odds of them being able to transition. But with 54,000 employees, I would say, you're now, just because they're offering AI solutions, according to them, doesn't mean that they couldn't still not be using AI to replace people themselves, but it's unlikely, I think. So I think if you looked at other AI companies, they wouldn't have 50,000 employees. So yeah, it looks like that it's been a good business. I think there's cyclical risk, which is the biggest, clearest risk. And then there's probably AI risk that it's uncertain how they're going to be able to adjust to it. So those are the two things. Like if whoever asked me about this, one, you need to have an opinion about recession risk versus upside reward. So and then the next thing you need to have an opinion about is how successful these guys are going to be when it comes to transitioning to AI and data analytics, right? So those are, the first one is macro, the second one is micro and will require some work and digging, which is not usually what I do. I try to find the easy ones, not the ones that require me to do a lot of work, because I don't take big positions. If I took bigger weighted positions, then I would have to do deeper research and really be absolutely certain for each stock that I buy. I try to find the easy ones that have a high probability of working out and spread those bets around and let the probabilities work in my favor over the long term. So I take a little bit different approach. But hopefully that helps whoever asked about this focus on the things that they should focus on. Then if they felt comfortable about those things, then the valuation looks pretty good, decent, especially if it fell another, like if it got under a 20 PE, like back here, like on this 2023 dip, like down in the upper teens or about a 20 PE, that looks pretty reasonable if you think they can keep growing at mid-teens. So it's not so much a basic valuation question, it's these other two questions I think that you need to think about. All right, thanks for asking about this one. If you found this useful, hit the like and subscribe button. If you have a request, put it down in the comments, and I'll see everybody later.